Welcome to the Deep Dive.
Glad to be here.
Today, we're digging into an earnings call transcript for Yatsen, or maybe Yatsen, Yasut. You know how these names can vary, covering their first quarter 2025 results?
Right.
Our goal, as always, is to sift through this together, pull out the key insights, and basically give you the clearest possible view of their performance and strategy.
Without you having to wade through pages and pages yourself.
Exactly. So before we get into Yatsen's specifics, the call did set the scene a bit. The China beauty market in Q1.
Yeah, it was, let's say, moderate. Food retail grew about 3.2% year over year.
Which was actually a bit slower than total retail growth, right? That was closer to 4.6%.
Correct. Online beauty did okay, low double-digit growth apparently, but yeah, not exactly booming across the board.
Okay, so keeping that backdrop in mind, let's look at Yatsen's headline numbers.
Well, despite that market context, their total net revenues actually climbed by 7.8% year over year. Came in at RMB 833.5 million.
Pretty solid growth then.
It is. But honestly, the really big news, the major shift highlighted in the call, that's all about profitability.
Ah, yes. The bottom line. That's where things got really interesting this quarter.
Absolutely dramatic turnaround. They reported a non-GAAP net income of RMB 7.1 million for Q1.
Okay, 7.1 million profit. How does that compare?
Well, compare that to the same quarter last year when they had a non-GAAP net loss of RMB 83.8 million.
Wow, that's a huge swing from an 84 million loss to a 7 million profit.
Exactly. Their non-GAAP net income margin went from minus 10.8% a year ago to positive 0.9% this quarter. It's a fundamental shift.
Okay, so let's unpack that. How did they manage that 7.8% revenue growth? And especially, how do they pull off that profit flip? Digging into the revenue details, it seems like skincare was key.
Oh, absolutely. Skincare was definitely the engine here. While total revenue was up 7.8%, the revenue from their skincare brands just soared up 47.7% year over year.
Nearly 48% growth in skincare alone. In this market, that's massive.
It really is. And the call specified it was primarily their clinical and premium brands driving this.
Ah, like Galenique, Dr. Wu.
And Ailong, yeah. Those brands combined saw growth of 58% year over year.
58%.
Yeah. It really shows their strategy of focusing on these, science-backed, potentially higher margin lines is paying off.
Did they give specific examples of what products were doing well?
They did. They mentioned Galenique's vitamin C serum was apparently the top seller in its category on Douyin live streams.
Okay.
And the Secret to Excellence Active Cream was among the top 6 anti-aging creams on Tmall. The Micromask series was also a big contributor.
I remember seeing something about that Micromask line. They're still investing there.
Seems so. They talked about launching an upgraded, rejuvenating Micromask, even brought on a new ambassador, Douyin Chan, so they're actively pushing it.
Right.
And Dr. Wu also got to mention robust growth there too, helped by a wider product range and what they called a balanced channel mix. They highlighted collaborations on specific products like a purifying renewal essence toner and a new targeted acne cleaning serum.
It's such a stark contrast when you look at color cosmetics, though.
Oh, completely different story. Net revenues there actually decreased by 9.9% year over year.
Almost a 10% drop.
Yeah. The Q&A did touch on promoting new Perfect Diary foundation and stuff, but clearly it didn't help the numbers in Q1.
So the revenue picture is, well, it's mixed, but the huge skincare growth is more than making up for the color cosmetics weakness, driving that overall top-line growth.
Exactly. But that still doesn't fully explain the massive profit swing. How did they get to non-GAAP net income?
Right. The cost side of the equation.
Precisely. It wasn't just about selling more high-margin skincare, though that helps. It was heavily driven by some pretty significant cost management.
Oh, yeah? Total
Operating expenses actually went down by 8.6% year over year. And maybe more tellingly, as a percentage of revenue, expenses dropped from 98.1% last year down to 83.2% this quarter.
That's a huge improvement in efficiency, cutting nearly 15 percentage points off the expense ratio. Which areas saw the biggest cuts?
The most dramatic reduction percentage-wise was general and administrative G&A.
Overheads.
Right. As a share of revenue, G&A fell from 18.1% all the way down to 7.8%. That's over 10 points shaved off.
And how did they explain that?
The call cited lower share-based compensation, probably due to how vesting schedules work, the timing of stock awards hitting the books, and also lower payroll costs from reducing headcount.
Makes sense. Were there savings elsewhere too?
Yeah, pretty much across the board, just maybe not as dramatic as G&A. Selling and marketing expenses, S&M, also improved as a percent of revenue, dropped from 69.7% to 66.4%.
Okay.
They attributed that to more strategic spending and closing some less productive offline stores. Although they did mention higher spending on Douyin traffic acquisition, partly offset that because Douyin's becoming more important for sales.
Interesting trade-off there. What about fulfillment?
Fulfillment expenses also got better, down from 6.7% to 6.2% of revenue. Just better logistics efficiency, they said.
And R&D.
Yeah.
Still investing there.
R&D expenses were slightly lower as a percentage of revenue, too, 3.6% down to 2.7%. But the reasons given were lower lease costs and some share-based comp effects, not necessarily cutting back on actual research activity itself.
Okay, so putting it all together on the profit side, strong skincare growth, probably with better margins, plus really disciplined cost-cutting everywhere, especially G&A and S&M.
That's the story. It seems like a very deliberate, comprehensive effort to tighten the belt and boost efficiency, alongside that strategic shift towards skincare.
Makes sense. Now, looking beyond just the quarterly numbers, the call also seemed to emphasize their longer-term strategy, particularly around R&D, didn't it?
It really did. They kept bringing it up as a core competitive advantage. They talked about launching a third anti-acne research fund project with dermatologists, showing continued investment in, the science behind their products.
Right, backing up the efficacy claims.
Exactly. And they made a point of mentioning their Shanghai R&D Center got CNAS accreditation. Think of it like a globally recognized seal of approval for testing labs. It means their facility meets top international standards. Their Guangzhou Center already had it, so now both main centers are accredited. It reinforces that scientific, tech-focused image. They even mention a Bloomberg interview discussing their tech focus.
So really leaning into that science angle. And on the corporate side, there was also news about share buybacks.
Yes, the board approved a new share repurchase program. They can buy back up to $30 million worth of shares over the next 2 years, starting mid-May.
Which usually signals, what, management confidence?
Generally, yeah. It suggests they think the stock might be undervalued and they're confident about the future, enough to invest company cash in buying back shares. It sort of backs up the strategic progress they've been talking about.
Okay, makes sense. So finally, what are they forecasting for the next quarter, Q2? Did they give guidance?
They did. For Q2 2025, they expect total net revenues somewhere between RMB 810.4 million and RMB 889.9 million.
Okay, and how does that compare year over year?
That range translates to roughly 2% to 12% growth compared to Q2 last year.
So potentially slower growth in Q1 or potentially faster. Quite a range.
It's a decent range, yeah.
Yeah.
And they did add the usual disclaimer that this is just their current view and things could change.
Of course. So let's try and connect all these dots for you listening. What this deep dive into the Yatsen call really shows is a company in the midst of a pretty significant strategic pivot.
Yeah, it seems clear they're doubling down hard on that high growth, high margin skincare segment.
While at the same time, being incredibly disciplined about costs across the entire operation.
And it demonstrates how that combination, focusing on your strengths, especially profitable ones, and really managing efficiency, can totally change the financial picture. They managed to hit profitability even when the overall market isn't exactly red hot, and one of their major segments is actually shrinking.
It really feels like a story of transformation, driven by some very specific choices and solid execution.
That's how it comes across from the call, definitely.
Okay, so here's a final thought for you to chew on after this deep dive. We're seeing this huge split, skincare booming, color cosmetics declining. And the company is hammering home this message about R&D, science, efficacy. Is Yatsen basically changing its identity right before our eyes? Are they becoming primarily a skincare company? And if so, what does that actually mean for where they fit in the market going forward?
It's a really interesting question. And looking at these details from the call definitely helps you understand the underlying shifts that might be driving that potential transformation.
Well, thanks for joining us for this deep dive into the Yatsen earnings call.
Always interesting to dig into the details. Until next time.